Let us look at an example of how the debt or leverage can affect profitability and earnings per share or EPS. Suppose there are three businesses A, B and C, all of which have a total capital of 30 lakhs each. In business A, the entire 30 lakhs are invested by the shareholders. So there is only equity and no debt. In B, 20 lakhs is equity and 10 lakhs is debt. And in C, 10 lakhs is equity and 20 lakhs is debt. The equity in all these three companies is in the form of shares of 10 rupees each. So the number of shares will be equity divided by 10. The returns generated by the companies from their business at the rate of 13.33% on the total capital is 4 lakhs each, which is the earnings before interest and tax. Because there is no debt in business A, the interest payment is 0. The entire amount of 4 lakhs becomes earnings before tax. Income tax is 30% on earnings before tax. So income tax comes to 1,20,000. So the earnings after tax is 2,80,000. And since there are 3 lakh shares, dividing the earnings after tax by 3 lakhs gives us 0.93 as earnings per share. In business B, there is a debt of 10 lakhs. So the interest on debt will be 1 lakh. Earnings before tax will be 3 lakhs. Income tax at 30% on EBT will be 90,000. Earnings after tax will be 2,10,000. Dividing this amount by the number of shares will give us an EPS of 1.05. In business C, there is a debt of 20 lakhs. So the interest on debt will be 2 lakhs. So EBT will be 2 lakhs. The income tax will be 30% on the EBT, which will be 60,000. Earnings after tax will be 1,40,000. Dividing the EAT by the number of shares will give us an earning per share of 1.4. As you can see here, by increasing the debt and the leverage, the earnings per share have also been increased, which means that the shareholders actually earned more per share by actually investing a lesser amount of their own money. But this will work as long as the cost of debt, that is the rate of interest on debt, which is 10% here, is lower than the rate of returns that are generated by the business, which is 13.33% here. If the details like the total capital, the amount of equity, the amount of debt and the rate of interest on the debt remain the same as in the previous example, but the rate of return, that is the earnings before interest and tax, is now 6.67% as compared to the 13.33% in the previous example, then you can see that the earnings per share will actually decrease as the amount of debt increases. This is because the cost of debt, which is the interest on debt, which is 10%, is higher than the returns generated from the investment. So in this example, higher amount of debt means higher amounts of losses. The learning from these two examples is that factors like cost of debt and the earnings that can be generated from the investments should be carefully forecasted or predicted before deciding the capital structure of the business.